Now, next question. What are the best ways to hide assets in a divorce? All right. The best way to do it is remove the asset from any financial statement for years and years before the divorce. So the craftier business owners will be doing this maybe 5, 10, or more years in advance, making every decision. Now, what the holy grail of all divorce documents is the personal financial statement issued to a credit facility separate from the divorce. So if a small business, and many of them do, including me, have a line of credit just in case cash flow goes haywire and you need to make payroll. All right. So the business owner has to submit a personal financial statement to the credit facility. Now, that financial statement is submitted subject to the criminal penalty of perjury pursuant to Tennessee state law. And there's a statute that says that. So what all that means is that the owner is going to have a hard time running from a personal financial statement. Now, we're going to talk about a little bit straight cash. All right. Let's say you got a cash business that generates 50% of $2 million in cash, no credit cards. Let's call it I don't even know what those, but it used to be bars and other things like that, primarily where you pay in cash, yard services, other things. But what do you do with the cash? You don't spend it, number one. Okay, you don't want to spend cash that you're saving because your spouse is going to see it. And you don't want to put it in a bunch of toys like Sea-Doos and this and that, because I have never handled a divorce with Sea-Doos where somebody says, oh, I really want the Sea-Doos. Never happened. All right. So what do you do with the cash? You get a number of options. Do you give it to your brother and put him in a position where he's got to commit perjury for you if word gets back to your spouse? Plus, who do you trust? Are you going to trust a third party? Really? Is that what you want to do? And, because secrets are, just that. They're just truth waiting to get out. And people get mad at their family members and turn them in all the time. I mean, I can't tell you how many times I've been told where assets are by my client's spouse's family, because they like my client better. All right. So you got the cash. You could drive out of state and stick it in a safety deposit box in a bank. All right. Like if you're in Chattanooga, go over the state line to Georgia, but maybe somebody would look at that. And you could lie about the existence of the safety deposit box. Fine. Let's say you want to get adventurous and put money offshore. All right. You've got two problems. One, if you are going to do a wire transfer, you got the other half of the transaction. Where's it coming from? And still got to get out, and there's a paper trail. All right. Let's say you just want to take the cash and you want to play Miami Vice. So you got to drive down to Miami, get on a boat with $250,000 or $100,000 or $500,000 in cash, and ride that boat to a relaxed banking country. Well, good luck with that. I don't know about you, but I'm not excited about being on a boat with $500,000 in cash on, or whatever the amount is that's worth the trip. It's going to be enough to make me nervous. So my favorite way, and I go into this a little bit in my book, the Forensic Accounting Desk book, and to put on a little gentle plug for that, is do a little bit of everything. And what I try to point out in my book is if you do 3 to 5% here, 3 to 5% there, 3 to 5% in terms of suppressing your income or overstating your expenses, sooner or later, you're talking about some real money, and that can be very beneficial over time. Then, and I'll just let you know, if you're going to keep the money in the business, then it becomes a question of operating capital, and no judge that you're ever going to appear in front of in Tennessee is going to want to hear an argument about what is appropriate for operating capital for that particular business. It's just too esoteric and too difficult. So you've got the multiple avenues. And when I say 3 to 5% here and 3 to 5% there, I'm talking about both balance sheet and income statement. So increasing debt a little bit here and there, decreasing cash, because the other thing is one of the great places to go, and this is just an example, there's plenty, and you guys could probably do a better job of teaching this part than me, is bad debt. Before I went to law school, I was a junior accountant for a hospital holding corporation, and several of my roommates were doing accounting for hospitals. And to ensure that the CEO of a hospital got their incentive bonus, they would make an adjustment to the bad debt reserve. And so that would always have enough fluff in it that you could increase profitability for the hospital just enough so that the bonus was paid out, but not so much that it would impair a bonus in the next year. All right. So there's a million different ways you can make tiny adjustments here and there.